All right, Talk Ticker listeners, get ready, because today we're doing a deep dive into EOG Resources Q3 2024 earnings call.
Definitely some interesting stuff in here.
Yeah, we've got the transcript, obviously, and some market data. And, well, EOG is doing some pretty cool things.
Yeah, you know what's really interesting to me is just their consistency.
Okay.
It's not like they just had one good quarter. It's like they have this long history of just really strong financial performance.
Okay, so let's unpack that a little bit.
Yeah.
When you say strong numbers, what kind of numbers are we talking about here?
We're talking big numbers since the end of 2020, over $22 billion in free cash flow.
Wow.
Yeah, and that's money that they have left over after they've paid all their expenses.
Right.
Over $25 billion in adjusted net income, so that's basically their profit.
So they're making money hand over fist, but what are they actually doing with it?
Yeah.
I mean, that's what we care about as investors, right?
That's the question, isn't it? And EOG is clearly committed to sharing the wealth with shareholders, so they've increased their regular dividend by 160%. And they've paid out over $13 billion in dividends since the end of 2020.
Wow.
On top of that, they've bought back $3.2 billion worth of their own shares.
Okay.
And they've reduced their debt by 35%.
So they are really doing it all, growing the business, rewarding investors, and keeping their finances in check.
Yeah, it's a pretty impressive balancing act.
It really is.
And Q3 was no different. They beat expectations on oil, natural gas, and NGL volumes.
So that means they're pumping out more than analysts thought they would?
Exactly. And they did this all while keeping costs under control.
Really?
Yeah, they beat estimates on their per unit cash operating cost.
Nice.
So all of this translated to $1.6 billion in adjusted net income and $1.5 billion in free cash flow for the quarter.
Wow. So more growth, more profit, more cash in their pockets.
Yeah.
It sounds like a shareholder's dream come true.
Yeah, you could say that.
But how are they doing it? What's the secret sauce here?
Well, their success really boils down to two main ingredients: capital discipline and operational excellence.
Okay, let's start with capital discipline.
All right, so capital discipline basically means that they're not just spending money on any project that comes along. They are carefully selecting investments that will generate strong returns in both the short term and the long term.
So they're not just chasing growth for growth's sake. They're being really strategic with their spending.
Exactly. And that brings us to operational excellence.
Okay.
So they're constantly leveraging technology and innovation to improve their efficiency across the board.
Okay, so give me an example of that. Like, what kind of innovation are we talking about here?
Well, let's look at their Q3 performance. They exceeded production forecasts largely because their wells are producing more than expected.
Okay.
So it's not just luck here. They've made continuous improvements to their completion designs.
Now, remind me, what are completion designs?
Yeah, so completion designs are basically how they get the oil and gas flowing out of the ground once they've drilled a well.
Oh, okay. So they're basically fine-tuning the process to squeeze every last drop out.
Yeah, they're getting more bang for their buck. Yeah, and the results really speak for themselves. They've managed to increase their pumping rate capacity per frac fleet by about 15% year over year.
Okay, hold on, wait a minute. Back up. First of all, what is a frac fleet? And then why does that pumping capacity matter so much?
Okay, so a frac fleet is basically a bunch of equipment that they use to hydraulically fracture a well.
Okay.
Think of it like using high-pressure water to crack open the rock formations so the oil and gas can flow more easily.
Sure.
And the more pumping capacity they have, the faster and more efficiently they can get those wells producing.
So faster pumping means more oil and gas flowing sooner, which ultimately means more revenue.
Precisely.
Got it.
And this is where EOG's multi-basin approach really shines.
Multi-basin approach, what's that?
So they operate in several different oil and gas regions across the U.S., and they are constantly transferring technology and best practices between them.
Oh, so they're learning from each other and sharing what works.
Yeah, that's exactly right. It's a really smart way to drive continuous improvement.
Yeah, I like it.
Take their Delaware Basin operations, for example. They've implemented a technique called extended laterals.
Extended laterals.
Yeah, it basically means they're drilling these longer horizontal sections of the wellbore.
So I'm picturing, well, that's more like a sideways tree trunk than like a straight root.
That's a great way to visualize it.
Okay,
eh?
so why is that better?
Well, it allows them to tap into more of that oil and gas reservoir with a single well.
Okay.
So think of it like more time drilling downhole and less time moving equipment on the surface.
Right.
It just means less downtime and ultimately lower costs.
So it's all about efficiency again.
Efficiency wins again.
Longer laterals, more oil and gas, lower costs.
Yep, win-win-win.
Win-win-win. I like it. So what other tricks do they have up their sleeve?
Well, their in-house motor program is another great example of their commitment to innovation.
Okay, in-house motor program.
Yeah, so instead of relying on like rented drilling motors, they've started designing and building their own.
Oh, wow. They're really taking control of the whole process.
Yeah, they are.
But does it actually make a difference?
Oh, yeah, big time. They've seen a boost in the footage drilled per motor run by over 20% compared to using third-party motors.
Wow.
And plus, they're saving a ton of money by not having to constantly replace those worn-out rental motors.
Smart move. Very smart move.
So they are drilling faster, cheaper, and more efficiently.
Yeah, that's got to be putting some pressure on the competition.
Oh, yeah, for sure.
So they're not just sitting back and enjoying their success. They're actively exploring and developing new plays like the Utica Shale.
You got it.
So tell me a little bit more about this Utica play. What's so special about that?
So they are transitioning from exploration to development in the Utica,
Okay,
which means they're moving from testing the waters to actually ramping up production.
got it.
They've got 5 packages online now and producing some pretty good results.
Okay, so what kind of results are we talking about here?
Mhm.
Give me the details.
Okay, so their Utica wells are achieving amazing drilling and completion efficiency gains. Like, we're talking almost 13% increase in completed lateral feet per day compared to last year.
So they're drilling faster, they're completing wells quicker, and they're getting more output.
Yeah, it's kind of a triple whammy.
I like it.
And get this, they're projecting incredibly low well costs and super attractive finding and development costs.
Okay, how low are we talking?
Somewhere between $6 to $8 per barrel of oil equivalent.
Okay, now I see why they're so excited about this. They must have big plans for Utica.
Oh, yeah. They're planning a 50% activity increase there for 2025.
Wow.
Clearly looking to leverage some economies of scale and just milk this promising play for all it's worth.
This is all great news for EOG. But what about their balance sheet? They're taking on more debt, so are they taking on too much risk with this new strategy?
That's a great question, and it's really important to remember that EOG is being very strategic about this.
Okay.
Their plan is to increase their debt to a level that's more aligned with their size and their financial strength.
So they're not just haphazardly piling on more debt.
No, not at all. They're targeting a total debt to EBITDA ratio of less than 1 times at $45 WTI.
Okay, and can you break that down for those of us who aren't financial wizards? What does that ratio actually mean?
Sure. So EBITDA stands for earnings before interest, taxes, depreciation, and amortization.
Right.
It's basically a measure of a company's profitability before you take into account things like debt payments and taxes.
Okay.
So a debt to EBITDA ratio of less than 1x means that their debt is less than their earnings. Like, they could theoretically pay off all their debt in a year if they had to.
Okay, that makes sense. So it sounds like they're really striking a balance here. They're
Yeah.
using debt strategically to try to unlock more value for their shareholders.
Exactly. And this move should free up even more cash for shareholder returns and just give them the flexibility to pursue more strategic opportunities down the road.
Speaking of strategic opportunities, they're also developing this Dorado natural gas play. So what's their approach there?
So Dorado is all about disciplined, return-focused development. They're taking a very measured approach. They're currently operating just 1 rig there
Okay.
to make sure they're capturing economies of scale and really responding to the market dynamics.
So they're not rushing to ramp up production.
Yep.
They're being patient. They're watching the market.
Yeah, while they are optimistic about the long-term outlook for gas demand, they're also being mindful of those current inventory levels and just the potential for supply increases.
That makes sense. It's like they're playing chess. They're thinking several moves ahead.
Yeah, exactly. They're not just reacting to the market. They're proactively positioning themselves for success, both in the short term and in the long term. It's pretty impressive to see.
All right. Well, before we get into our This Is Not Financial Advice segment where we throw out some wild trade ideas, let's just take a step back and quickly recap what we've learned about EOG so far.
Okay.
So they're consistently delivering strong financial performance, they're managing their capital wisely, and they're actively optimizing their portfolio. Plus, they're all about returning value to their shareholders.
Yeah, I would agree that the assessment, they've got a really clear vision and they're executing it flawlessly. You know, it's no wonder that they're considered a leader in this industry.
All right, so it's time for the fun part.
Yeah.
This is not financial advice,
Oh, I like this part.
where we throw out a totally wild trade idea, something that's maybe not so crazy, but
I get me.
so we've seen that EOG is all about efficiency, right? Drilling faster, cheaper, squeezing more out of every well they can.
For sure.
What if they took that same mindset and applied it to something completely unexpected?
Okay, I'm intrigued. Lay it on me.
What if EOG went all in on vertical farming?
Oh, hold on a second. Vertical farming, like growing lettuce and tomatoes and skyscrapers?
Exactly. Think about it. They're already experts at managing these really complex projects. They're
Yep.
good at optimizing resource use, and they're used to dealing with really harsh environments.
Yeah.
That skill set would translate perfectly to indoor agriculture.
I see where you're going with this. It's definitely outside the box thinking, but it's not as crazy as it sounds at first.
Yeah.
I mean, vertical farms are going to be a huge growth market in the coming years, especially with all the concerns about climate change and water scarcity and food security.
And EOG could leverage their existing infrastructure. They have the engineering expertise and they have the financial muscle to really become a major player in that vertical farming space.
Yeah, they could even use their land holdings to build these massive indoor farms powered by renewable energy.
Oh man, that'd be amazing PR too.
Talk about a good PR move.
Like oil giant goes green, grows lettuce instead of drilling.
Yeah, they'd become like a sustainability darling overnight.
I know, right? Plus, they could tap into this whole new revenue stream, selling fresh, locally grown produce all year round. It's like a win-win-win.
Yeah, I like it.
Okay, maybe I'm getting a little carried away here.
Yeah.
But the potential is there. EOG could be at the forefront of a food revolution.
It's definitely a bold vision,
It is.
but they've got a history of making bold moves.
They do.
And they definitely have the resources to make it happen.
All right, let's come back down to earth for a second. What stood out to you most from this deep dive into EOG's earnings call?
Honestly, it's their commitment to capital discipline. I think it's really impressive.
All right.
You know, they're not chasing growth at all costs. They're making these really smart decisions and prioritizing long-term value creation.
It is refreshing to see a company that isn't, swayed by these short-term market pressures.
Completely agree. They're playing the long game, and it's clearly working. You know, they're delivering consistent results, they're returning cash to shareholders, and they're investing in their future.
And they're not afraid to innovate. They're not afraid to explore those new opportunities like we talked about with that Utica play.
Oh, yeah, absolutely. They're not content to just sit back and, ride out the oil and gas wave. They're actively looking for ways to evolve and stay ahead of the curve.
It's like they've got this growth mindset baked into their DNA.
Yeah, that's a great way to put it. They're constantly learning, they're adapting, and they're pushing the boundaries of what's possible.
And their balance sheet optimization strategy is a pretty bold move, too. It could really pay off big time for shareholders.
It's a calculated risk, but it's a smart one. They're really leveraging their financial strength to try to unlock even more value.
This has been a fascinating look at EOG Resources.
Mm-hmm.
I mean, they're firing on all cylinders right now, and their future is looking really bright.
Yeah, couldn't agree more. They're definitely a company to watch, both for their performance now and for their potential to really shape the energy landscape in the years to come.
So Talk Ticker listeners, what's the big takeaway here? What should investors be thinking about after this deep dive into EOG?
Well, I think if you're looking for a company that consistently delivers strong financials, manages their capital wisely, and is always looking for ways to improve, EOG is definitely worth taking a closer look.
Yeah.
They're not just riding the oil and gas wave, they're actively shaping their future.
And they're clearly committed to returning value to shareholders,
Yeah.
whether that's through dividends, buybacks, or just, smart strategic growth.
Exactly. They're a prime example of how a well-managed energy company can really thrive, even in like a volatile market.
So Talk Ticker listeners, what stood out to you about EOG's approach? Is this measured growth strategy the right play in today's market? Hit us up on social media. Let us know what you think.
And as always, this is not financial advice.
Of course.
But EOG's story is definitely one worth following.
Until next time, keep those tickers talking.